All right. Today is Monday, April 26th, and this is a recap for the stock market activities today. We are still in the calm before the storm, awaiting corporate earnings, and this happens to be the most important week of earnings in this season. Therefore, the market is waiting and waiting and waiting until we get more clarity regarding corporate earnings, specifically for the big cap technology names. We know that earnings will come out impressive due to the stimmies, consumer confidence, and spending. However, the market will be focused on guidance, not the actual earnings, because with the current valuations, these decent earnings have been already priced in. The question is, will the guidance be impressive enough to justify another rally and another leg higher? This is what we're waiting for. Today we got the earnings from Tesla, and on paper the earnings are impressive. It is the most profitable quarter for Tesla. Yet the reaction after hours for the stock is pretty much muted because the guidance is very vague. Now, the real reaction for these stocks, Tesla and the rest, will happen perhaps by the end of the week or even next week, because the market is not going to flush down one name or the other without knowing the full picture of earnings. So as we receive more and more earnings, the market will process the information in real time and it will develop an impression whether the earnings will permit another rally higher or a sell-off. And therefore, the true reaction for Tesla's earnings will perhaps happen by the end of the week or next week as we receive more earnings. The other thing we witnessed today is the reversal in yields. Treasury yields rallied higher overnight all the way to about 1.6% before getting rejected and trending lower. That in turn is the third confirmation that yields are facing a very stiff resistance. What happened earlier this year when yields started to blast higher? Out of control. The mania names, the high valuation stocks, crashed 50-60% in certain names. Now that we have another confirmation that yields are consolidating and perhaps trending lower due to the resistance, these mania names are catching a bid. And you saw those names, the likes of NEO, Li Auto, the solar names, Palantir, Plug Power, CCIV, the SPACs, all catching a bid. And we do have a confirmation in the options market for the rally for these names that perhaps we will see a pop all the way till the end of the week. So in the short term, we're seeing bets for a relief rally in these names. However, by the end of the week, we will receive core inflation data. And if that comes out hot, as expected, then yields will resume rallying once again. And therefore, these names will also reverse lower. The other thing we continue to monitor is the situation over in India regarding the COVID-19 infections. This is the worst episode of the pandemic hitting India right now. And the question is this due to a new variant of the virus? And is this new variant immune to the vaccination? Will it target younger people? And if that is the case, then the market will not be able to shake this off for too long. For now, the market is shaking it off because the COVID-19 picture here in the United States is getting a lot better. Furthermore, in the coverage tonight, I have more information for you regarding wage inflation and inflation in general. And stick around for the futures market coverage because I have new tickers for you, stocks that are benefiting from the inflation in commodity prices, specifically grains. Anyhow, let's start by covering the market's performance. And here we go. The Dow Industrial Average closing in the red, down 61.92 points, or a decline of 0.18%. The Nasdaq closing in the green, 121.97 points, or a gain of 0.87%. The S&P 500 also in the green by 7.45 points, or a gain of 0.18%. What about the sector's performances today? Leading the pack at number 1, materials, due to the rise of copper. Copper is getting very close of reaching all-time highs. A number 2 for the silver, technology, and a number 3 for the bronze, energy. Meanwhile, the laggards of the day led by defensives, utilities, and industrials. We're seeing weakness in defensives because we got a lot of earnings in that particular sector from the likes of Procter & Gamble, Kimberly-Clark, and today we got Albertson. And the market is not so impressed with the earnings from these names because they continue to mention the negative impact of inflation on their bottom lines. What about the advance to decline ratio for the New York Stock Exchange? 62% advancing versus 36% declining, and for the NASDAQ, 68% advancing versus 29% declining. All in all, a decisive day in the green, with confirmation from the advance to decline ratios. Moving on to the futures market performance. What do we see here? Muted action for crude oil. We saw declines for the WTI and Brent crude oil. Meanwhile, we saw gains across the board for softs futures, with exception of OJ, the only decliner, and cotton futures flat for the day. But the rally in lumber continues to go on and on and on. We are now reading over $1,400 in lumber futures. It is one of the most stunning rallies I have seen so far, not just in commodity prices, but stocks and every other asset prices. We saw massive gains for coffee futures, followed by cocoa and sugar futures today. What about metals? No significant movement for yields or the US dollar. Yields went higher overnight, then reversing lower, but all in all, not a retreat, a decisive one, at least from the technicals. And therefore, gold and silver pretty much muted today. Yet the gains came from copper, platinum, and palladium, closing with excellent gains today. Copper is closing at all-time highs. That becomes a psychological level to reach, and it acts as a magnet. There is no doubt that copper will reach all-time highs readings very soon. And therefore, you're seeing proxies for copper, whether it is Freeport-McMoran, Southern Copper, all rallying significantly today. What about meats? Lean hogs, no stopping sign here. Another day, more gains for lean hogs futures. Meanwhile, modest gains for both live and feeder cattle futures. What about grains futures? Stable today, but the trend has been noticeable, explosive to the upside, and therefore we're getting more questions on how to play the rise in, say, wheat prices, canola prices, corn prices, beside buying the futures. Here are some names, some tickers. You wanted tickers? Here are tickers to play the rise in grains and commodities futures. The obvious play and the go-to play is Deere. When agricultural prices rise higher, the demand for Deere tractors and products skyrockets, and Deere has been an explosive stock, one of the best performers since the November elections last year. The problem is, while I've been bullish on this name, I have missed on buying it because I've been waiting and waiting and waiting for a dip to buy. And that never happened. And therefore, I've decided to buy other names. So I decided to buy names from this list, the likes of Nutrin and SunOpta last year. However, these names are all rallying significantly higher along with commodity prices. So if you want to wait for the dip, you can do that. You can sell some puts, and if these names experience a correction, you get to buy them at the strike price. If you don't want to wait, if you have FOMO, the majority of these names, the valuations overall are not so extreme compared to big cap technology and other mania names, and therefore the dips in these names are to buy. So your strategy, if you have FOMO and you want to hop on the ride, is to buy these names and take profits along the way, perhaps even selling upside calls out of the money to create passive income from your investment. So when that correction happens, you're not going to feel bad, and you're actually going to use some of the proceeds to buy the dip in these names, adding to your position. Because for now, the Federal Reserve is allowing inflation to continue to rise higher, therefore creating a commodities, say it with me, super cycle. And for now, the trend remains higher for these names. So let's go through them. If you don't want to play the obvious one with John Deere, what about some fertilizer names? The likes of Nutrin, Mosaic. The tickers are NTR for Nutrin and MOS for Mosaic. Both are excellent names supplying fertilizers to farmers. I am currently long Nutrin, so I am satisfied with my fertilizer play. Here's another play. You can buy farming equipment stocks, seeding stocks, etc. The likes of CNH Industrials, the ticker CNHI. You also have Corteva, the ticker CTVA. You could also buy AGCO, the ticker AGCO. All of these are plays for the infrastructure of farming, supplying equipments, etc. You also have ADM, and this is one of the best plays for the rise in commodity prices because they single-handedly provide the majority of wheat and canola products in the United States. And the ticker is obviously ADM. There are other ways you can play the rise of commodity prices, specifically grains, for example, oats futures. Instead of buying oats futures, you can buy SunOpta, which is the largest provider of oat milk in the country. Now, SunOpta is experiencing a mini sell-off because we have a new IPO for Oatly, which is the oat milk company. I still like SunOpta a lot more. The valuation is more reasonable, and SunOpta is the provider for oat milk companies, including Oatly. Another way you can play the rise in commodity prices is buying Union Pacific or railroad stocks, because these names transport grains across the country. And as the prices of grains continue to inflate, companies like Union Pacific is able to charge more for transporting these goods. And the ticker here is UNP. Now, there are other companies in the packaged food category that are able to pass the inflation to the end customer. For example, Tyson Foods. This is a play for lean hogs, but once again, they have to pay more for livestock feed, and that extra cost will be passed all the way to the end customer. You have other names, the likes of PepsiCo, Kellogg, General Mills, Kroger. All of these names will be able to pass the extra cost to the end customer. What are you going to do? Not eat? And therefore, these names will thrive if commodity prices continue to rise higher. In theory, their input prices will also rise higher, but their ability to pass that extra cost and then some to the end customer makes them favorable names to play the rise in commodity prices. Moving on to the options market, the big casino, and let's review the action today. The notable theme is the dry volume. The volume has dried up significantly in the casino the last few weeks, but specifically today. Even names that usually trade over 1 million contracts a day, like Apple, traded below that level significantly. And the theme remains elevated call buying in the mania names, the likes of Churchill Capital, Palantir, Neo, and the tilted put-to-call ratio is allowing for many gamma squeezes to happen in these names, in addition to the retreat in the 10-year Treasury yield. But here it is, number one, Apple, with about 700,000 contracts. About 70% of those were calls. Neo at number two, with about 600,000 contracts. About 77% of those were calls. And at number three, Tesla. Not even earnings are exciting the crowd in the casino to bid on Tesla. And this is a clear illustration, by the way, to the absence of retail traders. A little over 580,000 contracts. About 60% of those were calls. But again, check out the call options volume for names like Churchill Capital, AMC, Palantir, heavy call buying today. It has been going on for a while, at least in names like Palantir, but perhaps the decline in Treasury yields, or the rejection I should say, allowed these names to blast higher. And the question is, will this allow for a relief rally in these names, at least for a few more days? That seems to be the bet, at least from the unusual activities in the options market today. Speaking of, here it is, and the theme is very clear. Buying protection for the overall market and specific indices, but in the short term, betting that these names, the mania names, the high multiple names, will catch a relief rally. For example, let's start with the ticker SPY for the S&P 500. They are making a bearish bet here by buying the 345 puts. Expiration date, June 4th. With expectations that the SPY will decline over 17% by then, and they were willing to pay about 45 cents a piece to enter this trade, all in all costing about $5 million. What about the ticker IWM? Small caps managed to outperform the market today due to the rise of names like GameStop, AMC, and even the reopening names. But we are about to see earnings, at least from the reopening names, and perhaps if we see disappointments in these names, the IWM will trend lower. And therefore, somebody's buying protection here or making a bearish bet against the IWM by buying the 209 puts, expiration date May 28th, with expectations that the IWM will drop over 8% by then. They paid about $1.60 a piece to enter this trade, bringing the total all the way to about $1.4 million. What about the trade for the ticker AMD reporting tomorrow? They're making a bullish bet by buying the 96 calls, expiration date May 21st, with expectations that AMD will rise over 12% by then. They paid about $1.25 a piece to enter this trade. All in all, bringing the total to about $850,000. What about the ticker CCIV for Churchill Capital, aka Lucid Motors? They're buying the 28 calls, expiration date this upcoming Friday, April 30th, with expectations that CCIV will rise over 17% by then. They paid about 35 cents a piece to enter this trade. All in all, bringing the total to about $250,000. What about the ticker LI for Li Auto? They're making a bullish bet by buying the 22.5 calls, expiration date May 14th, with expectations that Li Auto will rise over 8% by then. They paid about 70 cents a piece to enter this trade, which brought the total all the way to about $300,000. And here is a very interesting trade for GameStop, the ticker GME, and the name is blasting higher after hours, which makes this trade very interesting. They made a bullish bet buying the 180 calls, expiration date this upcoming Friday, April 30th, with expectations that GameStop will rally over 6.5% by then. They paid about $7.70 a piece to enter this trade. All in all, bringing the total to about $3 million. What about the ticker TSLA for Tesla? Reported earnings today after the bell. In this case, they made a bullish bet, perhaps not a wise one, because they bought the 795 calls, expiration date this upcoming Friday, with expectations that Tesla will rise over 8% by then. And they paid about $8 a piece to enter this trade. All in all, bringing the total to about $3.2 million. Now, the expectations from this trade was for Tesla to pop higher after earnings. Now, Tesla might take a few days before rallying higher, but at the end of the day, the entry cost for the trade was too much, increasing the likelihood that this trade will be a loser. Lastly, what about the ticker GMIA for Jumia? Another mania name with high multiples and high valuation. And this is yet another bet for a relief rally in these names. They're buying the 35 calls, expiration date May 7th, with expectations that the name will rise over 5% by then. They paid about $1.40 a piece to enter this trade. All in all, bringing the total to about $560,000. Moving on to the headlines that shaped the day, starting with macro news. In the morning, we got the data for durable goods. U.S. durable goods orders rebound in March, but supply shortages still gumming up the works, adding more and more to inflation expectations and the concerns that inflation will get out of hand. Are you listening, Mr. Jerome Powell? Because here it is, the mention of inflation in corporate earnings calls have skyrocketed, and there is a very decent correlation between the mention of inflation in corporate earnings calls and the core CPI, meaning that if the correlation holds, core CPI should also skyrocket higher. And by the way, I'm showing you indicator after indicator after indicator every single night between the correlation of core inflation CPI and, for example, the Empire State Manufacturing Index. Every single indicator showing that the correlation, for some reason, mysteriously decided to stop and take a pause. So is this due to a lagging reaction? And in the next reading of the core CPI, we will have a massive surprise to the upside, or is this due to the cooking of data that's going on in the Bureau of Labor Statistics? U.S. companies are raising prices to offset increasing input costs. Inflation is taking hold. There is no doubt about it. We knew it. We see it. It is real. But the inflation skeptics and deniers continue to say, hey, where is inflation? Is it here? Is it there? Meanwhile, the corporations themselves are talking about inflation not as if it's coming in the future, but it is already here, impacting their bottom lines and forcing them to increase prices. And here is an example for the surge in commodity prices, specifically copper. Copper surges to the highest level in a decade on expectations that supply will tighten as the global economic recovery gains traction. And as I mentioned in the futures market coverage, copper is getting very close to surpass all-time highs. It is just a matter of time. And it's not just copper alone. Corn, wheat, soybeans, vegetable oil, a small handful of commodities form the backbone much of the world's diet. They are dramatically more expensive. Are you listening, Mr. Jerome Powell of the Federal Reserve and other central bankers, or not? You're causing a starvation crisis. You are causing a hunger crisis. And all of that just to protect the stock market and real estate values. You know, the assets of the wealthy who own and control the Federal Reserve. Corn futures jumped to a 7-year high on supply concerns. There is a reason I have been bullish on corn since last year, and I've been buying corn futures continuously. The futures contracts traded at more than $6.50 per bushel early Monday, up more than $1 per bushel since late March. It's a massive surge, quite unbelievable, in a short amount of time. And here is one of the contributors to the rise in corn prices. The price spike has come as harsh weather in the upper Midwest has raised concerns about corn supply amid a broader rise for commodity prices. Rising commodities prices are also likely to stoke fears about potential inflation. Yet the Federal Reserve continues to say, where is inflation? We're not seeing inflation. Our CPI says that inflation is only at 1.5%. We need more inflation. Okay, let's see how this experiment ends up for the poor and the middle class. Ladies and gentlemen, we are all under the mercy of these mad scientists over at the Federal Reserve. What about the housing mania, the housing bubble? You know, the rich are making a lot of money from all the stimmies that magically ended up in their pockets and the elevated stock market and real estate values, and now they're splurging to buy second, third, fourth, fifth homes to the magnitude where there is a shortage of homes in these rich areas. In this case, the Hamptons. The Hamptons rental shortage has led to soaring prices. One house just rented for $2 million for the summer. We're not talking about the sale price of the house. This is the rent price for the summer. $2 million. Furthermore, a new beachfront home in Maui sold for $24.6 million on Friday, the most expensive transaction on the Hawaiian island in 5 years. And the buyer bought the house all in cash. There was a massive spending spree from the rich in converting paper gains in the stock market. You see corporate insiders and executives dumping stocks like crazy and converting the fake paper gains in their stock holdings. And they are buying and purchasing real assets like real estate. This is how the rich gets richer. Meanwhile, the retail crowd, the pensioners, the retirees, they continue to flow into the market buying at elevated prices, and when the crash happens, they fall to be the victims of the crash. Meanwhile, the rich, they've already converted their gains from fake money to real money, and when the crash happens, they sell these extra homes and they use the cash to buy the dip once again in the stock market, riding the ride once again. This time around, without the participation of retail investors and traders. Thank you so much, retail traders and investors. You created an insane bubble, a mania, the likes of the housing bubble in 2008 and the dot-com bubble, and you made us richer. Now we don't need you anymore. Matter of fact, we need obedient workers to fill in all the jobs in the economy, the minimum wage jobs. We can't let you win in the stock market forever. Retail crowd, go back to work. Obedient workers. And is there an end in sight for the housing bubble, the housing mania? Well, the supply is surging significantly and home sales dipped due to the rise in the 10-year Treasury yield. However, when potential buyers realize that perhaps yields bottomed and the trajectory for Treasury yields is higher, meaning mortgage rates will continue to rise higher, they will resume the stampede in buying homes above the listing price due to the FOMO impact. And therefore, I still see that the housing bubble will continue to inflate higher and higher and higher, which, by the way, will add to the misery of the homelessness crisis in this country. But hey, who cares about these bums anyways? The Federal Reserve doesn't care about homelessness. Jerome Powell says that he rides his bike, the modest man that he is, to his office at the Federal Reserve. And he is bothered because he keeps seeing tents of homeless people all over the place on his way to work. And he's bothered by it, but he says that the Federal Reserve doesn't have the mandate to do anything about it. Now, Mr. Powell, your policy of printing money out of thin air, flooding the system with unneeded cash that magically ends up in the pockets of the wealthy, leading to inflating equity prices and real estate prices, that contributed and perhaps created the homelessness problem to begin with. So yes, you are responsible for it, and perhaps you are responsible for fixing it. The problem is, you know how Jerome Powell will suggest fixing this problem of homelessness? By doing more of the same. If we continue to print money out of thin air, flood the system with more and more cocaine, perhaps some of that money will trickle down to the homeless and solve the homelessness problem. What a joke. More in inflation news. You know they have a shortage of rental cars over in Hawaii, and therefore tourists and movers to the island are resorting to using U-Haul trucks as rental cars. And U-Haul is making a fortune, charging over $700 a day to rent one of their trucks. And I know what you're thinking right now. You're thinking, what is the ticker for U-Haul? So here it is, UHAL, in your face. And you know one of the arguments for the deflationary camp is, but the prices of TVs, bro. TVs are so cheap. Wait for it. Here it is. Global chip shortage spreads to toasters, washing machines, and TVs. There you have it. If you are planning to buy TVs, you might want to do that right now, because soon enough, they're not going to have enough chips to manufacture all of these TVs. Now, what happens if all of us who are planning to buy TVs, but putting that plan on hold, realize that we're about to see a shortage in TVs, and perhaps hiking up prices for TVs due to the chip shortage? We're going to stampede to buy TVs right now, perhaps creating the inflation in TV prices. You see how it works? Psychology drives the demand, and when demand rises higher and the supply fails to keep up with the demand, you see inflation. Very simple. And by the way, speaking of demand, is the demand slowing down at all? Are we seeing any slowdown in demand? Absolutely not. And the reason is the stimmy policy is very popular. The spending policy, which is a quasi for MMT, is very popular. And now we're seeing Joe Biden's approval numbers surging higher. I guess you can say that Joe Biden's approval numbers are also inflating. The poll showed that 46% of Americans believed the president's $1.9 trillion COVID relief bill, which sent direct payments to Americans and extended unemployment insurance, among other policies, was a good idea, while 25% said it was a bad idea and 26% said they don't have an opinion. And rumor has it that the 26% who did not have an opinion ended up getting whacked by Vincent Vega. Anyhow, additionally, 61% of respondents said that they believe the worst of the pandemic is over in the United States, while only 19% think the worst is yet to come. Speaking of the worst yet to come, all of this inflation is sparking talks about an upcoming tapering. What does that mean for new subscribers to this channel? Remember, good news for the economy is bad news for the stock market. Why is that? Remember last year when all of the economic news was doom and gloom, the stock market was surging higher every single day. Why does the stock market thrive under bad economic news but flatters and underperforms under good economic news? The reason behind that is that the market is a cocaine addict. And the cocaine is fiscal and monetary liquidity. If we have good economic news, then the Fed has no choice but to slow down the cocaine operation, aka tapering, or perhaps even ending the cocaine operation altogether. Because keeping the cocaine operation while the economy is getting hotter and hotter by the day will cause hyperinflation. What happens when the drug addict, in this case the market, doesn't get its fix? It suffers a withdrawal, and therefore you're seeing stocks crashing. and underperforming. Meanwhile, the economy is receiving more and more good news by the day. The economy is getting hotter by the day. And the end of the party in the stock market, this insane mania, this insane orgy that's been going on since the March bottom of last year, the party will end when the Federal Reserve finally tapers the cocaine operation and down the line raise interest rates. The market will crash in anticipation of these decisions. We are perhaps not going to recover these prices for years to come, at least for certain sectors of the market. And now economists are expecting the tapering to happen sooner than the Federal Reserve is announcing. Now we have 45% of economists in the survey saying that the Federal Reserve will start to taper asset purchases by the fourth quarter of this year, 2021. Matter of fact, about 14% of economists surveyed in this poll say that the tapering will take place as soon as the third quarter of this year. The Federal Reserve continues to say we're not thinking about raising interest rates or even tapering the cocaine operation. And the economists polled by this survey are calling the Federal Reserve's bluff, Jerome Powell's bullshit. Among them is Mohamed El-Arian, who's actually saying that the Fed should start tapering now, because if it doesn't do this right now, the market will continue to inflate higher and we will see hyperinflation. Inflation will get out of hand, and then we will have to face the inevitable scenario of a big, massive market crash, whether it is the housing market, the equities market, doesn't matter. And this crash will morph into a bigger economic crash. It will spill over in the broader economy. So the Federal Reserve better start thinking about risk management.
I almost wonder how they could possibly pull that off, Mohammed, because even if they were to say something or indicate something, let's just say they point to inflation and how it's been growing. We get inflation numbers on Friday again, right after the Fed meeting. But if they were to start saying we're thinking about tapering, what would the market's reaction be? I don't know how the market ever is able to take hints at something instead of getting smacked over the head.
So, Becky, the question is, what's the alternative? And we saw last week the Bank of Canada start tapering. And we also saw the market shrug off correctly the news on the capital gains tax. Yes, there was, a moment of a momentary sell-off, but we shrugged it off. So I would rather that this reaction comes sooner than later. I'm really worried that what they hope is transitory inflation is going to end up being persistent inflation. And if we end up in a persistent inflation world, they're going to have to slam on the brakes. And the market reaction then will be much worse than what it would be if they just tapered a little bit now.
And by the way, what will be the trigger for the Federal Reserve to start tapering? Because the Federal Reserve is willing to tolerate commodities inflation, housing inflation, stock market inflation, used cars inflation, food inflation, diapers inflation, dog shit inflation. Doesn't matter. They're tolerating every single form of inflation. Matter of fact, they're turning a blind eye to the inflation that we all see around us. But they're not going to be able to turn a blind eye to this one. Are you ready for it? Wage inflation. God forbid inflation starts to impact your wages. Oh, no. We can't let that happen. Your wages going higher, that's where the party ends. No more. End the party. We need these bums of the poor and the middle class hungry and motivated to be obedient workers. We cannot afford to pay them more because that will squeeze our margins. Who are we? The rich and corporate America. But wage inflation is already happening. Restaurants serve up signing bonuses, higher pay to win back workers. With job openings above pre-pandemic levels, eateries from McDonald's to Wolfgang Puck's are battling for new hires. Nationwide, chains and independent eateries alike said they cannot hire enough workers to staff kitchens and dining rooms. Just as COVID-19 restrictions relax and more consumers want to eat out again. Fast food operators, including owners of Jimmy John's gourmet sandwiches restaurants, are offering signing bonuses for recruits. Chipotle is offering free college tuition to employees who work at least 15 hours a week after 4 months on the job. Now, that's not going to work. I'll tell you why. Because the new generation figured out during this pandemic that they can make more money sitting on their asses at house with the sweatpants, doing Twitch, TikTok, and OnlyFans. You know, you sell a picture of your feet to some moron online as an NFT, and now you're making more than these shitty jobs at McDonald's and Chipotle. Who cares? Free tuition. We don't even need college anymore. Oh, by the way, check my Robinhood gains, bro. Can McDonald's offer me more than what I'm making right now gambling in the stock market buying call options? Of course not. McDonald's, you want me to work for you? Show me the money, baby. Look at my gains, bro. My Robinhood gains. Of course, the weakest link here, the first people who will rush and stampede to apply for McDonald's once again, are the Robinhoodians. Because if the stock market or the crypto market crashes, they're gone. Boom. Meanwhile, the smarty pants of this generation, the ones who are doing Twitch and OnlyFans, those are the ones who do not need a job anymore. At least until creeps online don't find pictures of your feet appealing anymore. Continuing. Taco Bell is giving paid family leave to company store managers. McDonald's are assessing what pay and benefits its U.S. employees most want to better pitch the golden arches as an employer. You know, giving employees cheeseburgers as a bonus, that's not going to work anymore. Show me the money, baby. We want stonks. Pay us in McDonald's stonk, and we will be happy. Atlanta-based restaurant operator Daniel Halpern, who runs 50 TGI Fridays and other restaurants, recently increased hourly wages and is offering employees immediate pay. He says he's still short about 900 workers who have a long wait and empty tables. We just don't have enough servers, Mr. Halpern said. Here comes wage inflation. U.S. restaurants increasingly are seating and serving customers again. After a year when quarantining and seating restrictions forced many to launch online-only food brands or rely on takeout businesses. Sales at bars and restaurants rose 13.4% in March compared with February, the biggest month-over-month increase since June, the Commerce Department figures show. Here's the problem again, but servers, hosts, and line cooks aren't similarly rushing back. Restaurant owners say whether because they're fearful of COVID-19, that's bullshit by the way, have moved on to other industries or remain on unemployment benefits. Bingo, here it is. The generosity of the stimmies. Other sectors of the U.S. economy also are scrambling to staff up, with manufacturers, live events, and other companies wrestling with labor shortages. And here it is, ladies and gentlemen. Inflation works as what goes around comes around. The extra cost will be passed to the end customer. Us. Diners can see the effects. Some restaurant owners have said they're having to pass along some of the wage increases to customers in the form of higher prices. As other costs rise at the same time, consumer prices for fast food in March grew 6.5% compared with last year, the biggest year-over-year increase since at least 1998, Labor Department data show. But where is inflation? Is it here? Is it there? I can't see inflation. Where is it? The labor crunch is affecting service. Some McDonald's and Pizza Hut restaurant owners said they're closing some locations earlier in the evening than they would have if they were fully staffed, cutting off potential sales. Have you noticed how snobby the kids working in McDonald's are? They don't need the job. Check out my gains, bro. Dogecoin. Hey, boss, don't you ever dare talk down to me because I'm some teenager working at McDonald's. Check out my cum rocket gains, bro. And now the boss have to do the job. Subway franchisee owners are working behind the counter to help. Some IHOP owners said they cannot bring back late-night service because of a lack of servers. Food service job postings on Indeed.com in mid-April stood at 16.2% higher than it was in February of 2020. The job listing site said that reflected the highest number of openings for servers, cooks, managers, hosts, and other restaurant jobs posted since the beginning of the pandemic. And here it is. Supplemental federal unemployment benefits of $300 a week for laid-off workers this year are a barrier to bringing back employees. Some restaurant owners and economists said federal and average state unemployment payments can surpass the weekly pay for an employee working 40 hours at $15 an hour. The median hourly wage for a fast food worker in mid-2020 stood at $11.4 $47 an hour, the Labor Department data shows. So here it is, folks. Prepare for wage inflation. Lastly, in macro news, let's talk COVID, because COVID is doing a number on India, but the picture is getting a lot better here in the United States. We have the contrast between India and the US, but who knows? Perhaps there is a new variant, a black swan, floating around, and that will hit us soon. But for now, here it is. The Biden administration set to relax outdoor mask guidance. Furthermore, Dr. Scott Gottlieb, former CDC director, current bitch for the pharmaceutical industry, says it is now time to lift outdoor COVID mask requirements. And the CDC now saying that the risk for transmission outdoor is very, very minimal. So all of these beach closures last year, those were not needed. I wonder why. And here is a little hint for you for the potential of a black swan event. New COVID variant detected at Texas A&M lab shows signs of antibody resistance and more severe illness in young people. Uh-oh. But for now, we're gonna shake this one off. And here's the last bit of COVID news that I got for you tonight. Let me ask you a question. Do you own any cats? If you do, stay away from them. I mean, after all, they prefer it to be this way. I got some bad news for you. Your cat doesn't really like you. But here it is. Owners warned against cuddling their cats after kitten dies from COVID. And of course, upon hearing this news, cats around the world took a sigh of relief that these dirty, disgusting human beings with their slobbering mouth are gonna stay away from cats, at least for now. You know, so cats don't have to spend their whole day cleaning up the nasty mess left on their bodies by human beings. And the cat said, "Thank you, COVID." Moving on to market sentiment news, starting with the 21st century's tulip mania. You know, they keep saying that Bitcoin will be the replacement of all of these worthless fiat currencies. But what kind of currency have such fluctuations in price and volatility where you are down over 20% in 1 week, up 8% in a day, down again, up, down, roller coaster ride? What is the appeal for this kind of investment? It is in no way a replacement for any fiat currency. It is just a vehicle for speculation. And now we have the cryptomaniacs losing a lot of sleep, staying up all night, watching the chart with a big jar of lotion next to them, watching the action tick by tick. And now this kind of behavior is actually impacting their personal relationships. Their friends don't want to hear about their crypto investments anymore. They think that they have lost their minds. They're investing in tulips and even their intimate relationships. Honey, would you like to do some Netflix and chill tonight? No, not really, thanks. I'm good. Staying up all night watching the screen, the tick by tick Bitcoin action with a big jar of lotion next to me. And rumor has it that spouses of the cryptomaniacs are cheating on them with value investors. But if you thought the mania that we talked about last night with Scam Coin and Cum Rocket is insane, here is the whole menu for you. Would you like some pancake swap with your Cum Rocket, sir? Look at this one, Dracula token. This is the future, bro. And if you are looking at this list and you're saying, oh, what is this shit? What is this garbage? Rest assured, I got you covered. I got actual shit for you to invest in. Here it is. Poop Coin is now available for trading. I'm a poop coin millionaire. How did you make your wealth, Grandpa? By investing in shit, literally. More in market sentiment news and the mania of this bubble. Kanye West's first pair of Yeezys, whatever the hell they are, sells for a record-breaking $1.8 million for a pair of shoes made in China. I'm telling you, in this insane bubble, you buy Dogecoin, Dracula token, Cum Rocket, horse manure, dog shit, shoes, garbage, doesn't matter. Even if the pair of shoes doesn't even exist, you sell them digitally as an NFT. What kind of absurd, insane mania we're living in right now? If aliens visited Earth and saw this mania, they will say, all right, we're leaving. You thought the Martians were insane. Check out these bastards. Oh, and by the way, what's going on with the culties? Forget about Elon Musk. We'll get to him later. But what about Kathy Wood, Mama Kathy, Money Tree, the the Holy Spirit Whisperer. You know, she created the Space ETF not so long ago, and the Space ETF includes Deer and Netflix, names that have nothing to do with space. But perhaps all of the LSD Kathy Wood did back in the 60s is taking her to space. And now she's using her new ETF to buy the old ETF. The Space Exploration ETF owns 7.2% of the ARC 3D Printing ETF. Who the hell knows what kind of names are under that ETF to begin with? But what is the point of doing all of this? Creating new ETFs to buy the old ETFs? Is this a classic pyramid scheme or what? But don't you talk bad about Mama Kathy. She made me a lot of money. She's smarter than you are. We'll see. You think we haven't seen this movie before? In the dot-com bubble and all of the mega funds that chased the mania names at the time, regardless of valuations, outperforming the market, looking smart to everybody's eyes, funneling more investors' cash, and then what do you know, they all came down crashing, and nobody even remembers their name. What about other snake oil salespeople, the likes of Chamath, Predatoria, who preys on the dumb? SPAC sponsors are allowed to buy 20% of the company at a deep discount. Those extremely cheap shares let the creators make on average several times their initial investment, even if later investors lose money. Once again, the SPAC generation of investors, the Robin Hoodites, the donkeys, and the likes, are chasing these SPACs, thinking that they are good deals, good investments, bro. The problem is, as Warren Buffett said about the dot-com bubble, after the crash, Warren Buffett came out and said, "I told you so. You donkeys." Okay, he did not say donkeys, but this is what he said. The problem with this kind of investing is that people are investing in companies that are designed to make money off investors, not for them. And SPACs are the clearest illustration for this kind of scam. Chamath is the kind of predator who waits outside the schoolyard and he tries to seduce you with a cone of ice cream, only to take you all the way to the back of his van. And we're not talking about an ice cream van here. We're talking about a van with no windows. Moving on to corporate-specific news, starting with, you guessed it, Tesla, the souffle, which reported earnings, by the way, after the bell. And as I told you yesterday, the margins are going to look better on paper. And the reason is they have raised prices. So in paper, this is Tesla's best quarter ever. The problem is raising prices will shrink their market share. The souffle enthusiasts who think that Elon Musk is God and everything that comes out of his mouth is the gospel, they do not mind to pay the extra cost. If Tesla raises the prices all the way to 40 grand, 50 grand, doesn't matter. The culties will pay the price. The problem is, say in China, raising prices will shrink Tesla's market share because there are cheap alternatives without compromising the quality, by the way. NIO, Xpeng, all decent car manufacturers with technology matching or sometimes exceeding that of Tesla's. But here is the news regarding Reverend Elon Musk. He is now set to host Saturday Night Live on May 8th. And of course, the crew of Saturday Night Live are not happy about it. They are, matter of fact, confused and annoyed. Why is Elon Musk hosting the show with his dull sense of humor? You know, without the memes, this guy is boring, just like his tunnels. And at first I thought that the crew of Saturday Night Live should boycott the show until Elon Musk gets cancelled. But then on another thought, let him do the show. Let America see that this guy is overrated, dull, lacks sense of humor, and he is, a matter of fact, a psychopath obsessed with Mars. I mean, if this is what your girlfriend has to do to turn you on, you got issues, bro. She has to have alien scars on her back to turn on your ludicrous mode. Moving on to Apple, the iMob. The iMob has been stashing an enormous amount of cash outside of the country, specifically in Ireland. And the reason is because they don't want to pay taxes. They don't want to pay the tab they owe the country. But here we have Tim Apple announcing that the iMob will boost their US investment by about 20%, creating thousands of jobs in North Carolina. The problem for the iMob is that they are launching their new software, I believe starting tonight. But here's the problem. We have other companies, app developers, specifically Facebook and Mr. Zucchiniberg, who are not happy about the new rules of the App Store because the iMob are creating new rules that pretty much makes your phone into a monopoly for them to charge app developers whatever they want. And if app developers don't pay, watch out. We'll crack your kneecaps. We'll chop off a finger. You better pay the rent for the iMob or you're gone. Of course, Zucchiniberg are all waiting for him to make the next move, turn up the heat in the iMob, but so far he's doing nothing. But Germany is doing something about it. Apple hit with German antitrust complaint as it prepares to roll out new iPhone software. And perhaps we'll see more of that, not just by European regulators, but even here in the US. Of course, mind you that most of our politicians, our beloved politicians, own Apple in their portfolios. What about Luminar? One of my favorite names, and I am optimistic about this company. The problem is that the valuation is insane, so for now I am playing it via call options. But I like the name. If you want to talk about the future, bro, this is the future. And it happens to be a bullet stock. You couldn't find a more promising company than Luminar. And here it is. Luminar will bring its LiDAR tech to Airbus planes and helicopters. Moving on to Roku. The streaming wars are heating up. Roku warns of standoff with Google over YouTube TV. YouTube TV is being taken off Roku. And of course, YouTube want to create their own platform. Perhaps YouTube better start paying their creators, their independent creators a little more, rather than paying CNN and CNBC and shoving those down your throat. Moving on to the heat map analysis. And here is the action for the market today. The big cap technology names pretty much muted with the exception of Amazon, up over 2% today. And the reason is a rumor of an upcoming stock split. But the notable take here is we saw a big retreat for defensives, industrials, healthcare, real estate, the winners of last week and prior. And what's catching a bit again is the semiconductor side of the technology sector, in addition to the mania names and biotech names. The mania names and biotech names thrive when yields are trending lower. And therefore, earlier this year, when we saw yields surging higher, you saw all of these biotech names and the mania names, the likes of Palantir, Shopify, Neo, crashing down. And now that yields got rejected again from the 1.6% level, we're seeing these names rallying once again. What about the themes of the market, starting with the reopening names? Mixed picture overall, and we're going to see more earnings for these names in the days to come. But the interesting take here is American Express. American Express declined after earnings on last Friday, but immediately rebounded higher today. Whether that is sustainable or not, who knows? But from the action today alone, it is telling me that the appetite for the reopening trade is still here. They're buying any dip they can find in these reopening names. American Express down 3% after earnings. What do you know? Now it's up 4% right away the day after. That is a clear indicator that the appetite for the reopening names is still here. What about the inflationary names? Also a mixed picture, but once again, names like Freeport McMoran, for example, which is not included in this list, but it is an inflationary names, along with a name like Alcoa. Every time we see a dip in these names, and these names are related to commodity prices, by the way, the dips are bought aggressively. Alcoa was down last week. Today it is up once again over 6% in a single day. What does that tell you? It tells you that the appetite for these names is still here, and any dips we're about to see will be an opportunity to buy, absent of an overall market correction or a market crash. And by the way, notice the silent rally in names like WPC or WP Carry. Here is the chart, and you see the wedge consolidation, and it is breaking above that level. And therefore, I am adding WPC to my portfolio. There are still names, if you look very, very hard, there are still names to buy in terms of value, but they are becoming harder to find by the day. And therefore, we do need desperately a correction, a pullback in these inflationary names. What about the disinflationary trade? Positive picture overall with massive gains for the high multiple names, the likes of Peloton, Shopify, DocuSign, all closing with massive gains in the green. We saw a modest pullback for Snapchat, Snapchat was an outperformer last week on the heels of the earnings, but now we're seeing some profit taking. The real test, of course, for these names is the aftermath of big cap technology earnings, and whether yields are going to rebound when we receive the core CPI inflation data. Moving on to the charts analysis, starting with the SPY, the S&P 500 30 minutes chart. We have the double bottom formation, and that is indeed playing to the upside. The chart is consolidating right now in or around the support level of 417, waiting and waiting and waiting for what? The upcoming big cap technology earnings. Big cap technology earnings are not going to impact the Qs and the Nasdaq alone. The weighting in the SPY is huge, and therefore we're watching Apple, because as Apple goes, so will the market. For now, 417 is the support, and the chart is pretty much trading at all-time highs. The path of least resistance, specifically under a day with low volume, as we saw today, is higher, not lower. Nobody wants to sell until they see corporate earnings. What about the continuous contract from a daily perspective for the SPY? Overall, a bullish formation, a bull flag-like formation playing to the upside. But I am giving this a thumbs down. I'm not buying it because we are trading at elevated levels in the RSI, we are curling downward in the MACD indicator. The chart is extremely extended. Any bad news, and you will see a massive flush down that will take us all the way down, perhaps to the levels of 3,960. What about the Qs? 30 minutes chart. Similar story here. We had the reverse head and shoulder formation that was supposed to play to the upside, only to be interrupted by the Biden's announcement of an upcoming increase in capital gains taxes, which was immediately shaken off by the market, and now we're playing the reverse head and shoulder formation to the upside. The important level here is 340, which is support as of right now. So the chart will go back and forth, retesting this support in anticipation of big cap technology earnings, starting with Microsoft tomorrow. What about the daily perspective of the continuous contract of the Nasdaq? Once again, bullish formation, close to all-time highs and breaking to the upside. The problem is that we have a negative divergence in the RSI, and the MACD indicator, the momentum indicator, is very extended, and it is due for a pullback. While we have surpassed the level of 13,900 after spending a lot of time around it, the green light will come from corporate earnings. If Microsoft delivers, and then we have Apple and Amazon, then you will see the chart breaking out to the upside, a massive rally higher. However, if these negative divergences in the RSI and the MACD indicator are correct, then the earnings, regardless of how impressive they are, the Qs, the Nasdaq will decide to look at the half-empty side of the glass and sell off. And if that is the case, then we have 13,599 to look down to. And if that doesn't work, then we have 13,300, and the Nasdaq should at least catch some support from that level. I know I sound like Captain Obvious. If corporate earnings come out clean, then we go higher. If they're not, we go lower. But this is the reality of the formation right now. We're waiting and waiting, the calm before the storm. Anybody who tells you that this chart is going to break to the upside or the downside definitively, they're lying to you. Nobody knows what the reaction is going to be after earnings are announced. You can read the tea leaves, but making a prediction one way or the other is irresponsible. What about small caps, the IWM, 30 minutes perspective? Blasting higher, and the reason is we saw the mania names, the likes of GameStop, AMC catching a bid today. The weighting of GameStop in the IWM is stunning. It is pretty much becoming a meme ETF. And as GameStop goes, so will the IWM, even though the reopening names also have a huge weighting in the IWM. What about the daily picture for the RUT, the Russell 2000? We talked about 2,264 as the line in the sand. So far, the chart is breaking above that level. We are starting to break above the negative divergence in the RSI and slightly registering green impressions in the histogram in the MACD indicator. We need a confirmation. We need another massive candle to the upside to confirm any bullish trend. For now, all you know, this is a bull trap. The reopening names sell off, and GameStop, for whatever reason, it is very volatile, up significantly one day, down the other. If it sells off again for whatever reason, the Russell 2000 will go down with it, and therefore we do need a confirmation, and that could happen as soon as tomorrow. What about the dollar index, the Dixie? The Dixie, significant weakness here, but perhaps we're seeing a short-term bottom. We have the doji formation formation from the action today, signaling that perhaps the dollar index is about to rebound higher. What could be the catalyst for the dollar index to rebound higher? How about a market sell-off in a rush to raise cash? That would be an adequate reason for the dollar index to rise higher. Moving on to gold. What's going on here in gold? We're giving a bull flag formation here. Gold is consolidating under the soft resistance of 1800. But if the momentum continues, we have a positive divergence in both the MACD and RSI indicators, then this will play out all the way to the real resistance level in or around 1,825. Moving on to BTC, Bitcoin. Bitcoin, a massive rebound today to the tune of 8 to 9%. We talked about the oversold conditions last night from an RSI perspective. Other analysts also mentioned the 100 days moving average. I do not use moving averages because, from my experience, they're not really reliable. And the reason is the algos react to the moving averages the day off the crossing or the touch. And then the next day it forgets all about the moving averages. And therefore I stick to the RSI and the MACD indicators. So what do we see here? We talked about a bounce last night. And if the bounce can go all the way to reclaiming the trend line in yellow, then the chart turns bullish once again. Absent of that, the trajectory remains bearish. And we covered the weekly chart. The weekly chart, the most important chart, is saying the action in Bitcoin has turned bearish, regardless of the massive pops and rebounds you're going to see along the way. What about yields? Yields overnight reaching all the way to 1.6% only to get rejected, and now we have a mini bear flag formation. We have conflicting information because we have a positive divergence in the RSI and MACD indicators, at least from a 2 hours perspective. Yet we do have the mini bear flag formation. So we will have the resolution as soon as tonight. The action tonight will tell us whether to trust the positive divergences or the mini bear flag formation and the rejection we saw from the levels of 1.6%. What about the TLT? Stable today, nothing going on, trending in range, waiting on how yields will react tomorrow and throughout the week. We have a lot of macroeconomics data coming up this week with a lot of implications regarding inflation, and that will impact the TLT and yields accordingly. What about the VIX? I talked about the VIX, that the VIX is gathering energy, preparing for what? Preparing to blast above the level of 20, which happens to be the resistance for now. The MACD indicator and the RSI indicator are all pointing to a positive momentum for the VIX, meaning that the VIX will blast higher. If we are reading the tea leaves correctly, if the VIX is about to blast higher above 20, then the SPY is about to face a correction of about 5% or so. What about Apple, the big kahuna? Apple is consolidating underneath the resistance level of 135 in a bull flag formation. However, the resolution of the consolidation that has been going on for days, by the way, will happen after earnings. The chart is waiting for Apple's earnings. The momentum for now is to the upside, so the chart needs a clean beat on the top and bottom lines and a decent outlook surpassing the market's expectations. We have no clue what the market is pricing in already. The chart is for now in a wait-and-see mode. What about Tesla? What's going on here? Tesla is muted after hours. It went up higher today, yet after hours, it is giving up all of the gains, pretty much flat, not doing anything significant one way or the other. And I had an iron condor trade for earnings for Tesla, pretty much betting that the reaction will be muted after earnings. This has been the case not this quarter alone, but for the last 3 quarters. Tesla doesn't do anything after earnings, no big movements one way or the other, but the reaction lags. The reaction shows up the week after earnings week. Of course, if big cap technology names bomb their earnings, then Tesla will go down in empathy and vice versa. For now, the levels remain intact. The support at 720, the resistance 781.3, and the line in the sand remains 679. A weekly closing below that line will open the floodgates for more losses. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have a lot of indicators for the housing market, from the Chiller Home Price Index, the home ownership rate, in addition to the consumer confidence index. What about the earnings calendar? We have in the morning 3M, GE, and after the bell we have Microsoft, Google, Visa, and AMD. Grab your popcorn, because if you thought the market was boring the last few weeks, buckle up. The action is about to heat up starting tomorrow. That's all I got for you tonight, and I will talk to you again tomorrow.